I'm looking for something that will fake a lot of people out. I think will gap up post earnings, tag this resistance line as we've tagged it before, tag it once again, get rejected, and move down for the rest of the upcoming months to go back all the way to 305 to fill this gap by mid-October. I think that's the most likely scenario. That's just my humble opinion. So based on the PC, based on the CPC, based on the BP/SPX, based on the daily chart, based on the momentum, based on stock market seasonality, what we're looking for is continuation to 444, reject, come back down, fill the gap at 431, and potentially form a double bottom with a positive divergence. So where is the trap? Well, it is here. This is the exact trap that we're talking about. A quick counter move all the way back to the 50-day moving average. We're pretty much 1 day away from that bull trap completing on all indices and on Nvidia. So it's time to be very cautious. This is exactly what we were talking about yesterday, legends. It's time to be very careful. This rally wants to suck more bulls in before it puts in the actual bottom. That was a rewind within a rewind, a crash within a crash, a trap within a trap. Welcome back, you legends. I'm Dr. Cal, and things are going exactly as we've been warning for 2 straight days. Bulls walked right into this trap. Unfortunately, I feel really bad about what's happening. I got a lot of comments in my last 2 videos saying, oh, the market has bottomed, it's rallying, this is it, gamma risk, gamma squeeze, all that type of stuff. And yes, I get it, legends. We just have to be very careful, watch what the charts are telling us and not try to force our opinion on the charts. This is the stock market map for today, and it's red all over the place. I'm not going to waste your time today. Quick and to the point, just like yesterday. Let's get right into it. All indices are down. Sector performance, very obvious. Defensive rotation, everything red. The worst is technology. The best is the defensives, like utilities, real estate, etc. Let's get right into the daily chart. And what do you know? We got that rejection at the 50-day moving average. This prior level of resistance has now solidified itself as impenetrable. What happens next, legends? Well, just like what we've been discussing for 2 straight days, we're still looking for this low to be taken out, a gap fill of this 431 level to be completed, and at that point, we'll have to look back and reassess. Do we stop short of going all the way down to 420, or do we keep going? Both possibilities are on the table. If I look at the PPO today, how we were extremely close to a bullish cross just a day ago, how that completely reversed today, I would lean toward this 431 low to actually be toast, to be taken out. Today's price action produced such a decisive bearish engulfing candle that cannot be ignored. We opened above yesterday's high. We closed below yesterday's high. That's what's called a bearish engulfing candle. It opens above the highs, closes below the lows, completely shakes out everybody, fakes out the bulls. They think the market rallies, they enter, and then they get completely crushed. That's precisely what we have been anticipating and warning was going to happen for 2 days straight. If you guys appreciate these videos, you want me to do more, you want me to do them every day, please drop a like. We also now have YouTube memberships. They're just $6 a month, and it's just another way for you guys to support the channel if that's something you want to do, if we saved you from some pain, if you learned something new about technical analysis and how to identify levels. That's now a new way for you guys to support the videos, to enable me to make more of what you guys want. So what are we looking for now? Well, guys, look at this volume. Massive red volume, above average volume, bearish engulfing candle at a critical level of resistance. What does this structure look like now? It's very clear, right? We got a left shoulder, a head, and a right shoulder. So how do these structures play out? Well, let's just pinpoint the levels. Very easy to do. Let's use the horizontal line tool. This is the level of resistance of the shoulders. This is the neckline at 431. What happens after that? Well, pretty simple, guys. We measure the distance from the top to the neckline. We double that. We put it all the way back down here, and that provides a full measured move to the downside. And it's actually scary. Look at that. Takes us down to 404. Now that's early days, guys, and not all structures move all the way down to their full measured moves. So let's not get ahead of our skis just yet. What are the obvious levels? What are more obvious levels? Well, we have a very clear level here at this support line, this trend line that tagged the October bottom. It tagged the March bottom, and it will now likely tag the September October bottom. We're looking at a tag of this trend line sometime in this vicinity. If it breaks down, I think that opens the door for that full measured move to go down to 404. Can you imagine that? All the way from 460 to 404. Now, in the short term, in the very near term, we have to actually look at the 1 hour chart. So let's jump right into it. This is it. A lot of clear levels on this chart that I've been talking about for days and days and days. If you've been watching the channel, congratulations. I hope we saved you from some pain. Let's take a look at what's been happening. We had this very clear, clean, descending channel, rejected every single rally in this entire down move, including today's rally. In fact, I said precisely yesterday to watch for a gap up to start the day and to be careful of this gap because it will be used to sell. That's exactly what happened. Right now, we are right up against this significant resistance line in the 1 hour chart to close the day. The stochastic is at an overbought territory. Just be careful. If we gap up to start the day tomorrow, that could simply be a gap to sell, especially with momentum being overbought, especially with Nvidia, especially with the entire market rallying ahead of Jackson Hole. Remember, guys, what happened just before Jackson Hole last year? Exact same thing. Rally ahead of Jackson Hole. Then we got that soul-crushing crash. Please, guys, don't skip any part of this video. It's a 30-minute video that I've distilled down. There's no fluff. All the charts that I'm covering today are absolutely critical, so please don't skip any part. Watch till the end. I basically make nothing out of these videos, guys. I do them because you love them. Only way I make anything out of any of these videos is if you guys choose to support me by signing up for the Discord training community or by signing up for the YouTube membership. You don't need to pay for anything at all, but if you feel inclined to support what we're doing, you now have the options to do it and to have direct input into the kinds of videos that you would like to see from this channel. Okay, so we outlined this critical area, very obvious. We gapped up, we then completely sold all the way down. Let's extend this prior area of support. Let's see if we tagged it. Well, there you have it. We're pretty much exactly at that level. So what do we look for now? This move is pretty decisive. It's very large, very strong, very big move. So I would not be surprised to see some attempts, some small attempts. Either we gap up to start the day tomorrow and then continue to sell, or potentially try to rally early in the day and then reverse back down. Why? Well, we have 439.5. It will now yet again act as resistance. It acted as support here once we broke through it. It acted as resistance once we broke through it again. It will act as resistance again. So what happens after that rejection? Very likely, guys, we continue to move down all the way to fill the gap at 431. This is a gap that's been left unfilled since June the 26th. And now I fully expect this gap to be filled within the next several trading sessions. Now, here's one of the most critical things that we have to keep an eye out on. And it's this. What is the market reaction going to look like at 431? Are we going to get a lot of hammer candles, reversals to the upside? Are we going to get signs of a bullish reversal in the smaller time frames, in the 1 hour chart, in the 10-minute chart? or are we going to go down, move sideways, show no signs of strength? In that case, more likely we will continue lower to 422. By the way, guys, I created a video specifically teaching you how to identify these levels, how to draw them out on the chart completely on your own. It's called How to Read Any Chart in 3 Simple Steps. I would highly recommend you check it out if you want to learn how to chart out these exact levels that you see on my chart. So what's at 422? Well, we also have another gap. If I take a look at the SPY, what's at 422? Well, there you have it, guys. We have the support line straddling 420, 431. If we get multiple connections with the trend line, it will likely break. If we get 1 or 2 brief connections, we will likely bounce right off it. That's just another hint to look for in terms of how the market reacts at key zones. We don't try to predict here, guys. We try to react at the key zones, and those key zones tell us what the market is going to do. It's like trying to speak to a German person or a French person. If you know those languages, you're going to understand exactly what they're telling you. And if you understand these reactions, you will understand exactly what the market is telling you. What's happening on the Nasdaq? Look at this, guys. Again, second break of this trend line. And what tends to happen, guys, is the Nasdaq tends to lead the market. So when it breaks a key trend line, it is more likely that the S&P 500 will go on to break the same trend line, this trend line that I showed you. Why is 420, 422 important? Well, 422 is the gap fill. 420 is a critical area because it acted as an area of resistance multiple times, several times throughout the market action, including this prior resistance area, little resistance area here from August of last year, kind of getting a repeat of August of last year. Look at this, 420 rejected, and then we had that waterfall style sell-off. This bounce right here is pretty much exactly what we're seeing right now. It was this bounce that we had for the last 4 trading sessions, and then it got completely rejected today. So what are the key levels on the triple Qs? Again, I outlined these levels in yesterday's videos. 370 rejected. That means we go down to the next level. 365 broken through. It will now act as resistance. Any attempted rallies will now fail here. Any attempted backtest of this trend line will likely fail. And the next level that we're watching is 352. If we break that level, oh my goodness, guys, it's a long way down. It's a long way down to 332 to fill this gap left from May. Now, when we broke that trend line, the odds of going down there went from 20% to 50%. Now that we've broken the trend line twice, the odds go from 50% to 75%. So the odds of filling this gap within the next 2 months going into the middle of October are now 75% that we move back down here, 25% that we come up short and don't actually move all the way down to 332. So odds now are in favor of a deeper, stronger, more severe sell-off. Let's talk about the Dow Jones. Look at this, a bear flag, tried to rally to the 50-day, rejected today, went back down to the trend line. Does the trend line hold or does it break again? We have the Dow Jones sitting on the trend line. We have the Nasdaq sitting on the trend line. And the biggest clue as to what happens next is something that I discussed in yesterday's video, and it's this, the BPSPX weekly chart. This is the S&P 500 up top. These are the market cycles below that I hand drew after I noticed that the market was forming these lows exactly at these cycle lows. With one exception, 2021, we had what was called a swamp low because of that extremely bullish uptrend. We are now expecting another low between October of this year and January of next year. That's not the important part. Please, guys, pay very close attention to this next part because this is where the real money is made. Now, I want to show you what I noticed, the pattern that I noticed, and how I've studied it and how I've been applying it to find tops and bottoms. Here's the pattern. This is the BPSPX. I outlined this level at 38.4. This is my own take on this BPSPX chart based on what I've seen happen in the past, okay? Based on patterns that I've recognized. And here's what tends to happen. Let me use this vertical line tool to show you exactly what happens. Once we break 38, we tend to get extended weakness. Once we break 38, we tend to get extended weakness. Again, more selling. Again, more selling. Again, guys, look at this. More selling. Boom, more selling. Boom, more selling. Yet again, yet again. So in a bear market, whenever we dip below 38, we tend to get extensive selling, more selling for several weeks after the fact. In a bull market, when we tend to dip below 38, that tends to be the bottom. There you go. It bottomed 2 weeks later. There we go. This was the bottom. This was the bottom. This was the bottom. We had one exception to all of these red sell signals that told us more selling was coming. The exception was back here in May when this bullish volatility contraction pattern was forming. I made an entire video dedicated to this volatility contraction pattern. No one else, I did not see anybody else talk about this pattern. We discussed it in May, and this is one of the most bullish market patterns that usually leads to massive melt up moves. That's exactly what happened. We had that massive melt up move. Since then, we put that top in late July. Then the BPSPX went below 38, and we've got extended weakness. Okay, so now how do we use the exact same tool to find bottoms? It's very simple. Look at this, guys. After we dip below 38.4, when we recover that level, that calls the bottom. Here you go. Recovered 38.4, market bottomed. Again, here we go. Market bottomed. There you have it, folks. Again, market bottom just a week before this signal. Again, market bottomed 1 week before the signal. There you go, folks. It marked a bottom just a week. There you go, before this signal was triggered. There are multiple examples here, guys. It marked even short-term bottoms, even small bounces. It marks all of them. It marked the bottom 1 week after it happened. Here it marked another bottom. Here it marked another bottom. And look at this, folks. It marked the bottom perfectly in this example. So now, legends, based on those levels that I discussed for 31, the gap fill, the potential of forming either a double bottom with a positive divergence or going lower to break this neckline, break the trend line, move down to 420. What's going to tell us what's likely to happen after we fill the gap at 431 is this exact chart. If we fill the gap at 431 and then we see the BPSPX move back above 38.4, we will know that was a tradable bottom. In contrast, if the BPSPX never recovers 38.4, after we fill the gap at 431, that tells us that more weakness is coming. I hope that makes sense, legends. Okay, let's talk about the VIX. Again, I talked about this exact move yesterday. I said I want to see the VIX come below the 20-day moving average, then recover. That will put a lot of pressure on the market. That's exactly what happened. We have a bullish engulfing candle. It opened below the low of yesterday, closed above the high of yesterday on volatility. And guys, the volatility index really tracks put premiums in the stock market. Put options are basically insurance policies against prices declining. When the market is selling, you see volatility move up. You see the VIX rising. Let's draw in a trend line here. Look at that. We're still in an uptrend on volatility. That means we have to be extremely cautious. If the VIX makes a higher high, that inevitably tells us that we are going to break the low of 433, this prior low that we made last Friday, and we will likely move down to 431 or even lower. What if the VIX makes a lower high? In that case, it will actually establish what is called a bullish divergence. The S&P makes a lower low, breaks 433, goes down to fill the gap at 431. The VIX fails to make a new high. That will establish a bullish divergence. I talked about these bullish divergences in detail in all of my videos last week, so you can check that out if you're interested. Basically, guys, they pretty much mark every single stock market bottom and top. So let me show you again. Here it is. VIX fails to make a new high. S&P makes a lower low. That establishes a bullish divergence. That marks the low. Another example is here. This is the VIX. It fails to make a new low, a new high versus these prior highs. The S&P makes a new low that establishes a bullish divergence. Another example is here. This is the VIX. It makes a lower high versus this prior high. The S&P makes a lower low that establishes a bullish divergence and calls the bottom. So that's going to be one of the key signals that we'll be looking for throughout this sell-off. Don't tune out just yet, guys. Still absolutely critical chart. Critical chart. The PC and the CPC, the put to call ratio. This chart measures the ratio between puts to calls. When you see a lot of put buying relative to calls, that means the market is nervous and it's anticipating a sell-off. It called the exact top. The market topped exactly one day after the money time machine sell signal was triggered. This is my own variation of the put to call ratio buy and sell signal. You will not find this anywhere else. This exact chart, these exact signals are all available to every single member of the Discord trading community. So if you're a member, you will have access to this exact chart. So when do we get a buy signal? Very simple. We get a cross above 1.1 on the CPC. Then we move back down to something that looks like this. And after that, we get a bearish cross on the PPO that will establish a buy signal. I'll show you every single time this has happened. Boom, we move above 1.1, we come back down, bearish cross on the PPO, it called the bottom. Exact same thing, we move above 1.1, we move back down, we wait for the cross, we get the cross, that calls the bottom. Exactly again, move above 1.1, come back down, PPO produces a bearish cross, it calls the bottom. It calls the bottom. It called all of the bottoms of the 2022 bear market downtrend. Let's talk about the New York Stock Exchange Summation Index. The Summation Index is this, and below that, guys, is the McClellan Oscillator. What are we looking for? What tends to happen with these sell-offs is we get a dip, and then we get a second dip. The second dip corresponds with the bottom. We get a dip, we get a second dip. The second dip corresponds with the market bottom. We get a dip, we get a second dip. The second dip corresponds with the market bottom. We have a dip, we're now waiting for that second dip and for a bullish divergence that will likely correspond with another critical market bottom. In the meantime, the Summation Index continues to point down. We are still in a downtrend. Rallies will be shorted to the downside. We're still in a sell the rip environment, not in a buy the dip environment. Exact same thing on the Nasdaq Summation Index. We get a dip on the oscillator. The second dip corresponds with the bottom. A dip, the second dip corresponds with the bottom. Boom, a dip, the second dip corresponds with the bottom. Exact same thing now. We're waiting for that second dip. The second dip, guys, always without exception takes out the prior low. That means we will make a new low. Very likely. It is extremely rare to get the second dip in the oscillator without a lower low. The vast majority of cases, it produces a lower low, and that's what we're going to be looking for. Let's take a look at fear and greed. We are now in fear, the first fear reading in months. 44 on the fear and greed index. We're likely still going to move even lower. If I draw a trend line on the fear and greed index, we'll likely find a low somewhere around the 30 reading. If I draw up a trend line, that's where it's going to connect. Unlike everybody else, I do apply technical analysis principles on the fear and greed index, the index itself. I look for spikes, I look for triple tops, I look for double tops, I look for a spike and cup formation. I look for the exact same things that I look for in chart of any stock or any index. Example, we had a double bottom here. It marked the bottom in the actual market. This example, we had a spike and cup formation. That's a bearish structure. In this example, we had a triple top. That's a bearish formation. In this example, we had a double bottom. That's a bullish formation. In our current example, we're now in the process of potentially forming a double bottom. Tomorrow, folks, tomorrow, 10 a.m., the Fed Chair Jay Powell will come out to speak at the Jackson Hole Symposium. It's very important to see what the Fed says. If we get any hint of an additional rate hike in September, the market will not like it. The market will respond negatively. The market is pricing a 10% chance of a rate hike in September. And so if Jay Powell hints at another hike in September, those chances will be priced in the yield curve and will directly and immediately be priced in the market, with the market moving lower. The higher the yields go, the lower stock market valuations go. It's a direct correlation. Now, this is the most important chart in this entire presentation, and it's this stock market seasonality. Do you guys remember what I said yesterday? I said we top at the 17th, then we move down and make a lower low at the 19th, the 20th. What happened? By the way, guys, these are the trading days, not the trading dates, not the dates in August, but the trading days. So the 17th trading day, we get the top. 19th, 20th, we get a bottom. What happened? Let me show you exactly what happened. Let's use our measurement tool. This is August the 1st. Today is the 17th bar, the 17th trading day. Exactly got a top. That's why we have to use seasonality, guys. It looks at how the market behaved in the last 20, 30, 40 years. Okay, so we have to look at seasonality in what the market does. Look at that. We marked exactly like the seasonality told us. We obviously had a lot of signals that coincided with this exact level. We had this double top. We had the back test of the 50. So it all made sense. It all made sense. Analysis is just accumulating data points and extracting the useful information out of those data points. And that's what happened. We got the top on the 17th trading day, and we should get the bottom on, let's see, the 20th to the 19th trading day. So in fact, guys, by August the 29th, that means next Tuesday, based on seasonality, next Tuesday, we should fill the gap at 431. By next Tuesday, we should be at 431. If seasonality continues to play out as it has done so far. If you enjoyed the video, please slap that like button right in the face, subscribe to the channel, and click on the bell so you don't miss any of these important updates. If you want to support the channel and you want to have access to all of my personal trades, investments, my daily analysis, my trade setups that I share with everybody in the trading community, check out Money Time Machine on Patreon. It will be linked in the description below. If you like the videos and you enjoy the videos and you want me to do more of these free videos and you would like to show your support, YouTube channel memberships are now available. It's just $6 a month. All of the investment that you legends put into this channel, I will put right back into the channel to make more better videos and to do more of what you guys would like me to do. If you watched till the end and you enjoyed the video, give that like button a slap. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's all I have for you today, legends. I'll catch you in the next one. Bye-bye.
Oh, wow.